Assalamualaikum and good morning everyone. Today, my group will be present on the story of the Abolishment of Takaful Act 1984 and the Introduction of IFSA 2013. So my group consists of me, myself, SYAMIMI binti RIZALMAN, and second Mardhiyyah binti Nordin, SITI AMANI binti ZULKIFLI, FARAH binti AZMAN, and lastly KRITIGESWARI, anak perempuan P.RAMESH. So further introduction is that the development of the Takaful industry in Malaysia in the early 1980s was inspired by the prevailing needs of the Muslim public for a Sharia-compliant alternative to conventional insurance, as well as to complement the operation of the Islamic Bank that was established in 1983. So it had become one of the important transactions for Muslims and had been widely practiced. Due to the reason also, Takaful had been gradually developed and fully commercialized to rectify its role as an important part in the financial market. So basically, the definition of Takaful is that it is a financial transaction of mutual cooperation between two parties with the aim of providing financial security for one of them against unexpected material risks. So in Surah Al-Ma'idah verse 2, the authority for the Takaful, Allah has stated that help or ta'awun you one another in righteous and piety, but help you not one another in sin and rancor. Fear Allah, for Allah is strict in punishment. So these verses encourages Muslims to help each other or ta'awun in furthering good and helping the participants who are in need or in hardship due to peril hazard that before them. So currently there are two laws that govern Takaful operation in Malaysia, namely the Takaful Act 1984 and the Islamic Financial Services Act 2013.
For the content, we will discuss 3 points. The first point being on the Takaful Act 1984. As a brief history, in 1982, the Malaysian government had established a special task force to study the possibility of setting up an Islamic insurance company, and subsequently, following the recommendation of the special task force, the Takaful Act was gazetted for publication on 31st December 1984 and came into force on 1st January 1985. This has also led to the incorporation of the first Takaful operator in Malaysia in November 1984, and this act encompasses 69 sections which is divided into 4 parts. The focus point of enacting the Takaful Act is to govern the conduct concerning Takaful business. In regards to the application of Takaful Act in Takaful Malaysia, there will be 4 main points to discuss. The first point being that the Takaful Act provides regulations on Takaful business in Malaysia. Provided under this Act, Takaful business involves family, solidarity business, general business, and retakaful. This Act has stipulated that Takaful business aims and operation must not involve any element which is not approved by the Sharia, which includes riba, gharar, maisir, and so on. Therefore, Takaful business is regulated to ensure that the business is run prudently without compromising the interests of the participant and the industry. The second point is that the Takaful Act requires the registration of Takaful operator. Provided under Section 4 of this Act, Takaful business shall not be carried on in Malaysia by any person as Takaful operator except by a company as defined in the Company Act 1965 or by society registered under the Cooperative Societies Act. Now this is to ensure that the Takaful operator is a legally registered company to handle the Takaful business while also to prevent any fraudulent act towards the participant. The third point is to provide regulation on Takaful business in Malaysia. Now, the Takaful Act provides for the establishment of the Sharia Supervisory Council by the Takaful operator in order to ensure that the business operations of a Takaful operator are in compliance with the Sharia principle at all times. The fourth point is that the Takaful Act regulation provides for other purposes relating to the Takaful sector, which also includes retakaful, Takaful business, international Takaful business, and other purposes enumerated in the Takaful Act. Now, on to the main discussion on the abolishment of Takaful Act. Although it seems that the Takaful Act had covered conclusively in regards to matters pertaining to Takaful, however, there are some matters that were either not addressed in detail or were not addressed at all, supposedly due to this inconclusiveness that the Takaful Act were abolished and replaced with another act. some of the reasons that can be adduced for the abolishment of Takaful Act is as follows. The first reason for the abolishment of the Takaful Act is due to the Act itself is silence on the issue of participant response. As previously mentioned, the Takaful Act have gaps in which they do not cover many parts on Takaful issues, in particular the issue of participant response. While the Takaful Act did define Takaful as a scheme which aims to provide for mutual financial aid to the participant, however, the definition is silent on the existence of the fund itself, of which the purpose is to maintain the contribution donated by the participant. The second reason, the second supposed reason is being to the absence on the issue of late payment of Takaful benefit. Now, since the Takaful Act 1984 was one of the earlier governing law that was enacted for the purpose of implementing Takaful in Malaysia, it is undeniable that there are certain matters which was not addressed. For instance, the issue of late payment Takaful benefit. In consequence to the absence of this issue, the regulatory guidance on late payment of Takaful claims was absent in the Takaful industry. The third reason being the absence of ruling on hibah. Hibah or gift is a concept that is being customized to fit the needs of contemporary development in Islamic banking and finance. However, there is no such ruling being stipulated in the Takaful Act regarding the application of hibah in Takaful, and this has led to many issues to arise regarding hibah in Takaful plan, whereby participants may be denied to apply for hibah in Takaful since there is no ruling which allows such application. The fourth reason for the abolishment is because the issue of permissible Takaful interest were not specifically addressed in detail. The abolishment of Takaful Act can also be due to the fact that there were some issues that were not specifically addressed in details pertaining to Takaful. Case in point, take the issue of permissible Takaful interest. The Takaful Act did not specifically describe the requirement of permissible Takaful interest, either the application in family Takaful business or general Takaful business. The first reason being that the Takaful Act restricted the inclusion of other recipients to the Takaful benefit. The Act had restricted the recipient of Takaful benefit to the participant only. Now, this is mainly because the Act did not emphasize the status of a recipient of Takaful benefit. Section 65, paragraph subsection 4 of the Takaful Act provides a very general interpretation for proper claimant in the sense that it may possibly include all possible legal heir. This, upon the death of the participant, the beneficiary will receive the Takaful benefit. However, since the status of the recipient is not specifically stipulated in the Takaful Act, where only a general definition exists, then the Act restricted the recipient to the Takaful benefit to only the Takaful participant. Thus, in an effort to reorganize the regulatory framework of the insurance and Takaful industry while also trying to improve the Takaful business in Malaysia, the Islamic Financial Services Act IFSA 2013 was introduced. With the enactment of IFSA, the Takaful Act along with other individual acts, namely the Islamic Banking Act, the Payment System Act, and the Exchange Control Act, were repealed. Then, the Takaful Act and the Islamic Banking Act were merged and updated into a single act which is currently known as IFSA 2013.
Islamic Financial Services Act 2013. So its objective is to introduce a more risk-focused and integrated approach to the financial institution, and this is also to supervise the financial stability. Aside from that, it is also to provide a comprehensive Sharia-compliant legal framework, and this ensures the effective functioning of money market, foreign exchange market, payment systems and payment instruments, and lastly, this is also to strengthen the consumer protection in the financial products and services. So among the many importance of IFSA is that it gives a better definition than the one that has been prepared by the Takaful Act. In Takaful Act, it provides a loose indication that the beneficiary will receive the benefits, but in IFSA, it has provided specifically that the word benefit, the beneficiary will receive the benefits. And also in Takaful Act, it uses the term in case of need, which gives a wide interpretation of events. However, in an IFSA, it gives the wording pre-agreed event to better specify and also minimize the scope of risk. So application of IFSA 2013 in Takaful Malaysia. Actually, there are a total of 291 clauses in IFSA. However, only 5 clauses are related to the Takaful. So the first clause is on the conversion to single insurance or Takaful business. So for this clause, it actually provides that takaful operators who hold composite licenses are now prohibited from operating both general and also family takaful business. However, licensed professional reinsurers or takaful operators are exempted from this prohibition in that BINM has allowed a grace period up to 5 years for it to de-emerge into separate entities. The second clause is the financial reporting obligation. IFSA recognized the importance of financial reporting, which Islamic financial institutions need to undertake. This helps adding the transparency as well as enhance the complicity to the Sharia framework. The third clause is on the limitation on individual shareholding. So after IFSA 2013, individual is now allowed to hold not more than 10% of the share interest of a licensed person, but the statute allows for equity interest exceeding 10%, provided that the individual provides enforceable undertaking not to exercise control over these shares. The fourth clause is on the financial holding company requirement. IFSA requires financial holding company to be identified and also to apply to be submitted to BNM to be approved as the financial holding company. So this allows the BNM to have oversight power over these companies who pose a risk to the financial institution. So any company which holds an aggregate interest in the licensed person's share for more than 50% must submit an application to the bank to be approved as the financial holding company. And lastly, the last clause is on the power of minister to prescribe institutions. So based on some recommendations by the bank alone or by jointly with other relevant authorities, the Ministry of Finance may prescribe any person not under the bank's supervision to be engaged in the financial intermediation activities as prescribed financial institution. But this is only when the bank is of the opinion that when the person is or likely to pose a risk to the financial stability.
Now moving on to the correlation between Takaful Act 1984 and IFSA, which is the difference between Takaful Act and IFSA. So the first difference can be seen in their definition regarding takaful. The previous Takaful Act defined takaful as a scheme based on brotherhood, solidarity, and mutual assistance, which provide for mutual financial aid and assistance to the participant in the case of need, whereby the participant mutually agreed to contribute for that purpose. While when we compare to IFSA, actually IFSA defined takaful as an agreement based on mutual assistance under which takaful participants agree to contribute to a common fund providing for mutual financial benefits payable to the takaful participant or their beneficiary on the occurrence of pre-agreed event. The major difference regarding this definition is IFSA actually mentioned regarding pre-agreed events, while Takaful Act actually silence on the pre-agreed event that they are signing on that contract. So moving on to the second difference is regarding the participants' risk fund. Takaful Act actually is a schemes that provide for mutual financial aid to the participant, and the participant agreed to contribute for such purpose. However, when we see this definition, actually this definition is silent on the existence of the fund, of which the purpose is to maintain all contribution donated by the participant. But IFSA 2013 actually has included the definition of common fund such as Tabarruk Fund, or we known as Participants Fund. With this element actually we can see that actually IFSA 2013 has filled the gap of Takaful Act. Means that Takaful Act has a few loopholes and IFSA has filled that gaps. So moving on to the next difference is regarding the beneficiary. Under Takaful Act, it's only benefits to the participant only. So for example, if the participant died, then he or she will not receive any Takaful benefit from his or her beneficiary. And we also can see that actually Takaful Act loosely describes the payment of mutual financial aid to the participant in the case of need. When we look at the Act, it mentioned regarding the word of in the case of need, but what is the case of need actually is not specifically defined. But when we compare to IFSA, IFSA has overcome this situation or this loophole by including the beneficiary of Takaful participant as the reception of the Takaful benefits upon occurrence of pre-agreed event. It means that under IFSA, a participant, which is someone that paying for that policy, can receive benefits from the policy that they are paying. And IFSA also has defined and description by stating that the case of need actually refer to the pre-agreed event as mutually agreed in the Takaful contract, which is under their certificates. This means that case of need depend on each case of that policy holder. So moving on, next is regarding the Takaful license. Under IFSA, it's required a Takaful operator with a composite license to separate its family Takaful business from its general Takaful business. It means that under IFSA, a person should have two different licenses to conduct the Takaful. However, when we look Takaful Act, the old Act actually allow the operator to carry on both business under the same company. And the next difference is regarding the minimum capital requirement that needed. Previously, which is under Takaful Act, a minimum capital requirement of 100 million was required to set up a Takaful business. But in IFSA 2030, it states that the minimum capital requirement will be specified by the regulator. It means that the minimum capital requirement is depend on the end of that regulator. So the next differences can be seen in the pre-contractual obligation of disclose in writing. As we all know that Takaful operator has a duty or obligation to inform participants regarding whatever element in that contract they are signing. But when we see Takaful Act, actually it's silence on the requirement of providing or informing participants about the implication of the Takaful contracts. It means that under Takaful, the Takaful operator does not have to or does not need to inform participants regarding what the element they are signing. And this is totally different with IFSA, which is under IFSA, before entering into contracts, a Takaful operator is required to disclose the consequence of pre-agreed contract as well as the pre-contractual obligation of disclosure in writings. It means that under IFSA, the Takaful operator in a good faith should act as a transparency. It means to disclose or to tell regarding everything about their contractual obligations. And the last difference is regarding the statutory age of Takaful contracts. Under Takaful Act, a person under the age of 18 are not permitted to enter into Takaful contracts, which is stated Section 64 of Takaful Act 1984. And when we compare to IFSA, under IFSA, the statutory age for contract is lower to 16 years old. It means that a person above 16 years old can enter into contract under family Takaful.
In conclusion, due to the Takaful Act 1984 inconclusiveness, it was abolished and merged with the Islamic Banking Act 1983 to inform the IFSA 2013, since under the TA 1984, the beneficiary to receive the Takaful benefit once the participant died was not well regulated, whereas the latter Act 2013 is more comprehensive and did cover all baffling issues that were not properly defined or stated in the Takaful Act. This is because IFSA was enacted to reorganize the regulatory framework of the insurance and Takaful industry. Therefore, IFSA has a significant impact on Malaysian Takaful operator, as it can be seen from the main changes mentioned above. This event would have a major impact on Malaysian Takaful companies, and as a result, the market will undergo significant shift. That's all from our group. Thank you.